What if I told you that the total American household debt was over $13 trillion? Yes, with a T. It goes without saying that there are a significant number of people in debt, and in this video I want to share one of the most effective methods for eliminating debt: the snowball method. The snowball method is a 4-step debt reduction strategy that works by paying down your debts in order of smallest to largest, no matter the interest rate. Now, let's go over these 4 steps in more detail so you can say goodbye to your debt for good. Step number 1, arrange your debts from smallest to largest. On a piece of paper or an Excel spreadsheet, list out each of your debts in order from smallest to largest. This could include things like credit card bills, owing to family members, student debt, and even car loans. When making this list, remember that you are organizing these debts by their outstanding value and not the interest rate. While many people will argue that the debt with the highest interest rate should be paid off first, this isn't the best method for everyone. You see, if you start by tackling any debt other than your smallest one, you may start to become discouraged as you pick away at your higher value debts. Not seeing nearly instant progress for many people is enough to have them quit on paying down their debt altogether. This is why the snowball effect is so powerful, because you can start to see your progress right away as you begin to stroke out all your smaller debts soon after implementing this method. The final part of step number 1 is to write down the minimum payments for each debt you have, and then you're ready to move on to step number 2. Step number 2, make the minimum payments on each debt. Now that you have all your debts documented, it is now time to start paying them down. Each and every month, you're going to want to pay the minimum payment on each debt. By making the minimum payment on each debt, you will avoid hurting your credit. And in case you weren't aware, your credit rating affects numerous aspects of your life, like your ability to get a mortgage and obtain favorable credit cards and even get you a job. Step number 3, pay as much as you can on the smallest debt. Now, like I said in the last step, you will want to be consistently paying the minimum payments on all of your debts. That is, except the smallest one. That smallest debt, which if you set up your working paper correctly, will be at the top of your list, is the debt that you will now place most of your attention on. Your goal is to pay down this first debt as fast as possible. In order to do this, you may consider taking on extra work, such as freelancing, or working overtime to make this happen. Some very lucrative freelance jobs I've done in the past include graphic design, business coaching, and copywriting, but you should pursue jobs that match your own skill set. After committing to paying your smallest debt down on a consistent basis, you will soon be able to stroke off the first of your debts and move on to the next one. Step number 4, roll over your payments and repeat until you're debt-free. You've now crossed off your smallest debt and it's time to move on to the next one. In order to put the snowball method into full effect, what you will do next is begin to pay down your second smallest debt. But instead of making the minimum payment, you will contribute the minimum payment from the last debt paid off, plus the minimum for this current debt. Moreover, like the last time you paid down a debt, all the extra cash you have available should be put towards this second smallest debt while still continuing to make the minimum payments on the larger balances. Once you get the snowball rolling, you will soon begin to notice that you'll be contributing larger and larger amounts towards your debt, making them disappear in no time. When was the last time you actually paid cash? More likely than not, every single one of your purchases is paid using the tap of a credit card, and given this fact, it's no surprise that as of 2019, Americans are in more than $1 trillion worth of credit card debt. Therefore, in this video, I'm going to share with you 5 of the best ways to pay down credit card debt fast. And if you're new to the channel, make sure to hit the subscribe button below for more life-changing content. Tip number 1, look at your credit card debt in chunks. Let's face it, the thought of paying down your credit card debt can be intimidating, especially if you have a large balance to repay. For many, this intimidation can lead to total avoidance of repayment altogether, but luckily there's a solution. If you've ever gone for a long run, you'll know that it's much easier to think of the run as 4 15-minute chunks than a full hour run, and this same principle can be applied to your credit card debt. For example, instead of thinking about the $20,000 of debt you owe as a single amount, consider it as 4 different chunks of $5,000 each. While splitting up your total amount into more manageable chunks doesn't naturally cause your debt to decrease quicker, it can get the debt elimination process started if the large balance you've been carrying has been turning you off from making any size of repayment whatsoever. As a rule of thumb, especially if you have multiple credit cards with an owing balance, Ensure you make the minimum payment so that you avoid hurting your credit score, which can be influential on things like getting a mortgage and even securing a job. Tip number 2, pay down your highest interest credit card first. While it sucks to have debt hanging over your head, the real issue is the exorbitant interest fees you pay when you carry a balance. The average credit card has a 19.24% annual percentage rate, or APR, which is much higher than you would pay when securing financing for a mortgage or a car. This steep interest rate, when allowed to compound, can turn a $1,000 computer into a $1,500 one pretty quick if repayments are ignored. So if you have multiple credit cards with balances outstanding, the fastest way to pay them down is to start with the card with the highest interest rate. By doing this, you will cut down how much you pay in interest on a monthly basis, allowing you to put the bulk of your repayment towards the principal. Tip number 3, ask family or friends for a loan. Another effective way to pay down your credit card faster is to ask for a loan from family or friends. While mixing money and family can often be inadvisable, the benefits of lending from a friend or a relative to pay off your debt can be worth it. For example, if you have $10,000 worth of credit card debt with a 20% APR, you will be shelling out $2,000 a year on that balance. However, let's say your Uncle Bob lends you the $10,000 to pay off your debt at just 2%. Your total annual interest would be then reduced to just $200, meaning that good Uncle Bob will have saved you a cool $1,800. Now, a note of caution is that lending from family can cause tension, especially if repayment extends beyond the agreed upon time frame. Therefore, if you borrow money from a family or a friend, make sure to create a contract of how much is being borrowed, at what rate, and for how long to ensure both parties are on the same page. Tip number 4, consolidate your credit card debt. Another fantastic way to reduce your interest charges from your current credit card debt is to consolidate your balances using a credit card consolidation loan. This method involves moving all your credit card debts onto a single debt that is subject to much lower interest rate fees, much like what we just talked about in the family and friend loan situation. You see, typically banks will offer this type of loan at an interest rate lower than your credit cards if you promise to repay the loan within 3 to 7 years, making it an excellent debt elimination tool. Let's illustrate the power of this method using an example. Let's assume that you have $10,000 of credit card debt at a 15% interest rate. If you can consolidate your credit card debt with a personal loan at 7% interest and a 3-year repayment term, you will save $2,634 and pay off your credit card debt earlier. Tip number 5, earn more money. When people talk about paying down debt, they hardly ever talk about earning more money. However, this is probably the most powerful strategy for paying down your debt quicker. Whether it's due to unfortunate life circumstances or poor money management, many people just can't scrape enough money together every month to pay off their balance, causing them to slowly fall into the interest charge vortex. Luckily, one way to make larger payments on your credit card debt is to make more money. Whether it's through picking up a part-time job or doing freelance work, making more money that you specifically use to pay down credit card debt will ensure you become debt-free in no time. In the past, I have done freelance work in graphic design, coaching, and copywriting to make extra cash to put towards my debt. And while practicing the other methods I have mentioned in this video, earning more money was definitely the most effective way to clear all of my balances. So if you're serious about eliminating your credit card debt for good, roll up your sleeves and get to work. If you have any amount of debt to pay off, you're probably wondering what the best debt elimination strategy is that will get you back in the positive in the fastest time frame possible. In the United States, debt has been skyrocketing year after year, with personal consumer debt surpassing $4 trillion in 2019, which means that Americans could be doing a much better job when it comes to paying down their debts. In this video, I'm going to share with you one of the quickest methods of paying down your debt, the debt avalanche method. And if you're new to the channel, hit the subscribe button below for more informative content. You're probably asking yourself, what is the debt avalanche method? Do I need to be able to ski? Will it be cold? The debt avalanche method is a strategy of paying off what you owe by prioritizing loans and credit card balances with the highest interest rates. You see, while it sucks to have to look at a huge debt balance every time you check your bank balance, what's worse is paying annoying interest charges. At least when you accumulate debt by buying goods and services, you get value out of those things, but interest charges are zero value added expenses. Therefore, the goal of the debt avalanche is to minimize the amount of interest you pay, allowing you to put more money towards paying off the principal, which in turn will allow you to be debt-free much sooner than if you were to use other strategies like the debt snowball. Now that you have a good idea of the principles behind this debt elimination strategy, let's now get into exactly how you can set up your debts to be able to pay them down as fast as possible. Step number 1, list out all your debts. On a piece of paper or an Excel spreadsheet, list out each one of your debts from the highest interest rate to the lowest. This could include anything from money you owe to your brother, to credit card debt, and even your car loan, just to name a few. An important point to note is that you are trying to arrange your debts from the ones with the highest interest rate and not the highest interest charge. While a large balance with a smaller interest rate may be costing you more money every month than the one with the highest interest rate, in principle, having the loan with the highest interest rate still outstanding is the most costly. Step number 2, make all your minimum payments. After you've listed out all your debts from the highest to lowest interest rates, it's now time to write down each of their respective minimum payments. Every month, it is critical that you make the minimum payments on each one of your debts, as missing payments will not only increase your debt, but will also affect your credit score. In fact, being just 30 days late on a payment can reduce your credit score by up to 100 points, making getting a future mortgage or even a job that much harder. As a best practice, set up a reminder in your phone to make each one of your payments, because oftentimes life can get busy, and having a reminder means one less thing you have to worry about. Step number 3, pay down extra on your highest rate debt. Now that you've set up your debt listing and have made all your minimum payments, it's now time to really get the debt avalanche rolling. In order to do this, what you'll want to do is put any disposable income you have towards your highest interest rate debt. And if you're thinking to yourself, I wish I had extra disposable income, then it's time to roll up your sleeves and get to work. Most people have more free time than they think, and one of the best ways to use this time is to make more money. This could be in the form of taking on more shifts at work or picking up side projects. No matter what this extra work looks like, the key is to funnel all that extra income towards your highest interest rate debt, allowing you to pay it off as fast as possible. Step number 4, keep the avalanche rolling. At this point, you're making solid progress at paying down your debts by prioritizing them and earning extra cash to put towards them. Within no time, you'll be able to stroke off the first debt on your list, allowing you to begin focusing your attention on the second one. In order to keep the avalanche rolling, you will need to do 3 things. Continue to make the minimum payments on each debt, earn extra income, and finally add all previous debts' minimum payments to your new monthly debt contribution. So for instance, if the debt you just paid off had a $200 minimum payment, you will add that amount to the minimum payment contribution on your next highest debt, creating an avalanche effect of a much greater payment. And this larger payment, when compounded with extra income you're earning, will make your debt load evaporate in no time. Now, let's jump into my computer and go over a demonstration of how this process works. Alright, so let's assume that we have some debt to pay off, and the debts are the following. We have a credit card debt, we have a personal loan, we have a private student loan, we have an auto loan, and finally, we have a medical office bill. And the balance for the credit card is $16,000, and that one has a rate of 17% interest. Furthermore, we have the personal loan, which has a $2,000 balance and has a 7% interest rate. Furthermore, we have the private student loan at $13,000 at 5%, the auto loan at $21,000 at 4.75%, and finally the medical office bill is $1,300 and there's absolutely no interest attached to it. So now let's say that we have an extra $150 available each and every month to put towards our debt. Which loan should we pay off first? Well, before we get into that, I'm going to fill out what the minimum payment is for each one of our debts, and then we'll go from there. As you already know, when you're using the debt avalanche method, you're going to want to pay the debt that has the highest interest rate attached to it, and any extra money that you're going to put towards your debt will also go towards that balance. So in this circumstance, we have the credit card that has a $16,000 balance, and it has a 17% interest rate, which is higher than any of our other debts. This means that we're going to be making our minimum payments on all of our debts every month, but when it comes to our credit card, we're going to make that minimum payment of $480, and then we're going to add the extra $150 to it every single month until it's paid down. Now, after paying off your credit card, that minimum payment goes away, so that $480 is going to be gone. This means that you're going to have even more cash flow available each and every month to put towards your debt. So the $630 you were paying to your credit card company can now go towards your personal loan, which is the loan with the second highest interest rate. As a result, you pay $669.60, which is the $630 that you've previously been paying, plus your required $39.60 as well. This larger payment will have that balance paid off in absolutely no time. So the next thing you're going to do is fold what you are paying on the personal loan into your additional payments, so you'll pay an additional $669.60 per month on your student loan. The total amount you send to your loan servicer is $853.34, which is the $669.60 plus your required $183.74. So effectively what you're doing is each previous payment is being added to the minimum payment for the next debt you're paying off. And as you continue to compound or avalanche your payments, you will soon become debt-free. What if I told you that it's possible to erase thousands of dollars of debt by employing a few key money management principles? Well, in this video, I'm going to share with you exactly how I paid off $25,000 worth of debt in a year. And by following these steps, you too can be debt-free in no time. And if you're new to the channel, hit the subscribe button below. Now, before I get into the exact steps I took to pay off $25,000 worth of debt, let me quickly share with you how I got into this financial mess in the first place. When I was in my early 20s, I'll admit my spending habits weren't the greatest. For instance, nights out at the bar with friends routinely cost me a couple $100s, which over time amounted to a pretty large amount of money. Unfortunately, this type of frivolous spending was only part of the problem. At that time in my life, I was extremely focused on impressing others. The opposite sex to be more specific. And this again prompted me to spend. From new clothes to fancy dinners, it's safe to say that my more youthful years were a spending disaster. Now fortunately I was living at home at this time, so the financial damage was not exacerbated by having to pay thousands of dollars in living costs. But with these bad spending habits added to a sizable amount of student debt, I found myself in $25,000 worth of debt. After a few years of this reckless behavior, I had an epiphany. One day, I was cleaning my room when I came across an earnings statement from my final year of college. As I skimmed over the paper, I saw my annual income was $20,000. While I was now making significantly more at my full-time job, it hit me hard that I was in more debt than I used to earn in a whole year's worth of work. It was at this point that I knew I had to confront my money troubles and get back on the path to a debt-free life. My first step in eliminating my debt was rather unorthodox. Having a type A personality, I have always been driven by goals. Therefore, before paying down even a cent of debt, I wrote down exactly how much debt I wanted to pay off and in how long. While ambitious, I wrote, pay $25,000 worth of debt in 12 months. And with that as a new set goal, I knew I had taken an important first step in eliminating my debt for good. My second step was to consolidate my debt using a line of credit. At the time, I had no idea about debt consolidation, but what I did know was that I was paying a hefty cost each and every month in interest charges. At this point, I had about $10,000 worth of credit card debt that had an annual percentage rate of 22%, so every month I was paying more than $100 in credit card interest, which was only compounded by my monthly student debt charges. Luckily, after talking with my bank, I was able to put my $25,000 of debt on a low-interest line of credit, which instantly shrunk my interest charges from about $200 a month down to just $30. My third step in paying off $25,000 was setting up a budget. Up until this point, I had never budgeted my spending, let alone tracked it on a daily basis. So one night, I sat down and wrote out my estimated income for the upcoming month, as well as my typical expenses like cell phone, groceries, bus pass, etc. I even budgeted for my nights out, which was a telltale sign that I was taking my finances more seriously. Once I had my budget in place, I knew that following it would be a challenge, so I began to consider methods to help me adhere to this money management tool. One night I was at the gym for my weekly personal training session, when my trainer asked me how well I had stuck to my diet the previous week. Proudly, I told him that I had not deviated from my diet all week, and that in fact I had lost another 2 pounds. Then it hit me. I need a money trainer. I then asked my good friend Justin to check in on my budget adherence on a weekly basis, which over time really helped me stay on course. After a few check-ins with Justin, it became clear that most of my slip-ups were linked to credit card spending. It was all too easy for me to charge my credit card when out of the store, as each tap of the machine didn't even feel like I was spending money. So after realizing my ongoing mistake, I chopped up my credit cards and committed to only spending cash until my debt was paid. About 6 months into my debt elimination journey, I was starting to make a dent in my debt, but to be honest, I was feeling rather discouraged. Having paid off about $10,000 in the first half of the year, time wasn't on my side if I was going to pay down the rest of my debt within my previously established 12-month time frame. My problem didn't relate to spending less, as my budget was super tight, allowing me to funnel almost all my disposable income towards paying off my debt. My real issue was that I wasn't earning enough to pay down my debt faster. You see, at the time I was making about $3,000 a month, after tax, and was shoveling just over $1,500 of it onto my line of credit. Unfortunately, if I wanted to pay off the $25,000 in 12 months, I would have to pay down $15,000 more in just 6 months' time, requiring me to contribute an extra $1,000 a month towards my debt. However, there was no way I could reduce my expenses to allow me to contribute more, so instead, I had to focus on making more money. Being an accountant, I knew that people hated doing their taxes themselves, so I figured this would be an excellent way to make some extra cash. After offering up my services on Craigslist, I started working with multiple clients every month, which helped me generate a good amount of extra income. After the 11th month of my debt elimination journey, I looked at my line of credit balance and realized that my extra work had really accelerated my progress. In the 5 previous months, I had paid down another $10,000, leaving me with just $5,000 more to pay. However, even with this increased income, I was still only able to put $2,000 a month onto my debt, meaning that I would be $3,000 short at the end of the 12 months. In order to make up that extra $3,000, I began looking on Craigslist for extra jobs to take on when I came across an ad for a used TV. It then hit me that I didn't necessarily have to work to make more money, and that I could instead sell off a few of my possessions to make up the difference. After scanning my house for things to sell, I gathered my mountain bike, some gaming consoles, and a lot of sports memorabilia, which I was able to sell for a few $1,000s. Fast forward to the end of the 12th month, where I had made my final payment on my line of credit, completing my $25,000 debt elimination journey, and starting my new life as a debt-free individual.